Well, good evening, ladies and gentlemen. How are you doing? Spectre here for another edition of Midnight Rider. Glad you can join. This is episode 37 now. Tonight on the broadcast, we're going to talk about a few things pertaining to old Robinhood, the GameStop situation, Reddit, the folks behind that, the short selling, silver, where all this stuff is headed, and perhaps even take a little bit of a trip down memory lane as to some of the things that may be coming by way of silver and some of the manipulators of the past. So we'll see you back here momentarily on the other side. Warning. These social media platforms may be hazardous to your health. Censorship kills. Pain coming. This has been a PSA by Breaking Spectre. Alright, welcome back everybody. Like I said on the broadcast tonight, we're going to get into the whole flap that's been going on over the course of the last 9-10 days now with the GameStop situation, what is going on with the short selling, all that good stuff. Looks like we're up across the board. Had a little bit of a hiccup in that with DLive, but it looks like we are online now. So if you're joining on the YouTube side, welcome. Twitch, welcome to you guys. DLive, good to have you aboard. And of course, our friends over on the Tiger Network, good to have you guys aboard here this evening as well. All right, so I think what I'll start off with here tonight is kind of take a little bit of a walkthrough of what has happened over the course of the last 9 or 10 days or so. What really started this off. As somebody who tracks and archives the hell out of everything and have been for a number of years, yeah, a lot of history here. I got about 100 articles net dating back to about the 21st, 22nd time frame when this thing really started to take off. So dating back to about the 22nd of January now, Citron Research says hacking attempts interrupted live stream detailing GameStop short. I'm going to cover that article. I'm certainly not going to cover all 100 of these tonight. No chance of that. I will hit a few of these, of course, and then, like I said, I'm going to actually go back through some of my archives here, as it called to remembrance, where this thing is headed. Silver could be a potential one that the Redditors net may jump on as far as the short positions and whatnot, and take a little walk through history and see who some of the culprits might be and who the big hitters are. That being said, still on the 22nd, a lot of headline changes in that. That's why you see some of these indents, as they did actually change headlines several times throughout the day. Citron's left, I'm going quiet on GameStop after angry mob committed multiple serious crimes. And of course, that ended up the big short squeeze. Did Michael Burry just make a killing on GameStop? That's a little over a week ago now. So you missed today's epic move in GameStop. That was from last Friday as well. GameStop explodes in early trading, nears $10 billion market cap, and is AMC next. That was on the 25th. A lot of day trading stuff, a lot of articles net surrounding that from Rabobank, Bloomberg, Planet Free Will. Let's see, remote workers and Robinhoods routed as critical internet services suffer a major East Coast outage. There's been plenty of that going on as Monday, Tuesday, Wednesday of this past week, and even again today. Reddit saw outages on the East Coast. GameStop insanity. Stocks hit $385 even after shorts. Melvin, Citron capitulate. Like I said, Wall Street Bets responds to the SEC. Well, you get the idea there. E to D. Most shorted names soar after Wall Street bets reopens. So a lot of off the books stuff going on as well. Robinhood halts buying in GameStop, and AMC, Barstool's Portney, Slams app. They should all be in jail. And maybe you guys have seen some of the clips in that where Dave Portney was on with Tucker Carlson here in recent days, complaining about that as well. 70.87 billion reasons why the retail brokers just betrayed their customers. So obviously there's a bit of money on the sidelines. Let's see. Dogecoin up 800%. Wall Street bets. Elon Musk involved. So you got a bunch of other folks weighing in as well. Bill Gross, yet another hedgy, and that out there as well. SEC publishes statement on short squeeze insanity. Will protect investors from manipulative trading. Well, that's interesting because, like I said, I'm going to touch upon that here on the back half of the broadcast. Mark Cuban weighing in here in the last couple days. Mark Cuban presents a little trick for creating the mother of all short squeezes. If he's to be believed. Steve Cohen nukes Twitter account after getting personal threats over GameStop debacle. Let's see, silver futures soar. This is today, 8%, rise above $29 as Reddit hordes pile in. And just before broadcast, Ray Dalio weighing in. Recent market rebellion shows growing anger and intolerance in the U.S. So, just a smattering of headlines over the course of probably the last 9 or 10 days from a number of folks weighing in. Tom Luongo, Charles U. Smith, USA Watchdog, Data Trek Research, you name it. Everybody has got something to say about this. So that being said, let me just jump into some of the first articles I've got up for the evening. Oh, before I do, got to highlight this as this kind of transitions into what I had just covered by way of the World Economic Forum. And perhaps maybe these guys are right. Dear billionaires, you will own nothing and you will be happy. And of course, one of the articles tonight out of Zero Hedge says that one of the guys behind the scenes was planning on making some improvements to his property. About $44 million worth or something along those lines. I forget what it was. I would imagine that those plans are probably hitting the skids as we speak. In any case, what kicked it off? This goes back to the 22nd now. Citron Research says hacking attempts interrupted live stream detailing GameStop short. Says Andrew Left of Citron Research took to Periscope yesterday to try and lay out his short thesis on GameStop, which he claims is going back to $20 a share. Well, again, this is on the 22nd. I can't even say as of right now where it actually resides. It's been all over the map, as high as about $500 a share. But instead of completing his video informing the public of his investment thesis, Left found out firsthand the madness of crowds when he set off many GameStop bulls in the Wall Street Bets subreddit, who took to the web to make pests of themselves during his video. Left was then forced to stop his stream, explaining on Twitter that too many people were trying to access his Twitter account at the time. Twitter locked his account as a precaution, Bloomberg reported Thursday night, and eventually had to work with Left to get it reinstated. So apparently that was the pretext, according to Citron Research at the time, and apparently now the video is removed. That's interesting. This is a failing mall-based retailer, Left starts by saying, you can get mad, you can hack my account, you can go to Twitter, you can sign on and call me every name, but if you want to save the company, go out there and actually buy something from GameStop. That's the only way you're going to be able to save the company. Other than that, the more you buy, I'm sure there will be supply on the other side, Left concludes. And of course, apparently that video has now been scrubbed, or perhaps it's re-uploaded somewhere else. So continuing along those lines, still back from last week, on the 23rd, a big short squeeze. Did Michael Burry just make a killing in GameStop? And this was updated later in the day as well. This is after today's debacle in GameStop's share price. Our memory was jogged of an article from late 2019. Why Big Short investor Michael Burry is going long on GameStop, the video game retail that's been crashing all year. Says in August 2019, none other than Michael Burry, the famed Big Short investor who predicted and profited greatly from the subprime mortgage crisis of 2008, had taken a massive 3 million share position in the video game retailer in his hedge fund, Scion Asset Management. And I suppose if you're keeping track behind the scenes, you might want to keep a running list of all these hedgies behind the scenes and who the players are. But in August 2019, none other than Michael Burry, the famed Big Short investor who predicted, we got that one. So his reasoning for the position at the time, the beleaguered video game retailer is getting an extension of likes thanks to Sony and Microsoft, as both console makers are putting disk drives in their next-gen game consoles. In an interview with Barron's around the same time, Burry said GameStop position looks worse than it really is. With GameStop stock down so much this year, Burry thinks it's an opportune time for the company to buy back its shares. He noted that there may be mechanical selling by quant-oriented funds because of new lease accounting guidelines that went into effect earlier this year. The new guidelines drove GameStop's leverage ratios higher, he says, while nothing has changed fundamentally. Technical factors driving the stock to lows has created an opportunity for substantial buybacks at below private market prices, Burry said. There's no better use of capital than buybacks. And the latest data shows that as of quarter 3 2020 filings, he still had 1.7 million shares, and that's highlighted there. And so here you see some of the players behind the scenes. This, of course, via Bloomberg. So the question is, did Burry sell any more in quarter 4? Well, or did he just make another killing on the back of this market's bubble fantasy traders? The big short squeeze. Congrats to Michael J. Burry, who made another killing today. Rather ironically and extremely presciently, if he had held on today, Scion's letter at the time noted the short interest for GameStop represented more than 60% of the shares outstanding. And of course, at the time, this is where GameStop was headed. It's pretty much an asymptotic rise at this point as everybody is piled in. All right, so continuing on. This is kind of an interesting article to kind of explain the nuts and bolts of what's going on behind the scenes, perhaps why they had to stop trading via Robinhood the other day. I think you could sell, but you could not buy, which, of course, that is a manipulation of the market. So this gets into that. It says it's not just Robinhood. Reddit rebellion has clogged entire financial systems, plumbing. And I'm going to touch a little bit more on that as this goes on as well. It says while mainstream media is juggling with just who to be angry at and who to virtue signal for in the Wall Street Bets Reddit rebellion and Robinhood rout episode, the reality under the surface is that the U.S. financial markets have just been punctured by the thin blades of truth. As CHS recently noted, it is fatally wounded, but nobody dares notice. So what's really happening with Robinhood et al.? It says at Compound 248 details in this excellent thread, this is a plumbing issue. It is esoteric, even for those on Wall Street. Here's the explanation of how the toilet is clogged. So first, RH was not the only brokerage to restrict buying in GameStop et al. Much of the below applies to many brokerages. I'm going to use RH in my writing for simplicity and because it's the most prominent, but it's not fair to call this a Robinhood issue per se. And he's absolutely right. Again, because if you go back to Monday, Tuesday, Wednesday this past week, if you're not following Down Detector on Twitter, for example, you probably should, just for the simple fact that they track a lot of this stuff, the trading houses, the E-Trades, the Ameritrades, Robinhood, you name it. If you remember right, early part of last week now, Monday, Zoom and a bunch of others were down, and supposedly they blamed it on a cut cable or something up in the Bronx. But if that's to be believed, then why was there yet another one on Tuesday and Wednesday, and perhaps even again today? But I digress. The restrictions impacted retail and institutional players. Many institutional prime brokers, the PBs, did the same thing to their hedge fund clients. The question is why? Surely PBs can't be trying to punish their own clients just to benefit Citadel. There must be something else happening. Let's talk plumbing. Well, most RH clients and all HFs use margin accounts, not cash accounts. RHs sign up process nudges new customers into margin accounts by default. Whether Robinhood should do that is worthy of discussion another day. This is a story of lending and capital. Margin accounts are Wall Street's way of denoting lending accounts. Practically speaking, in margin accounts, the client does not own any securities. Rather, margin account holders own a promise from their broker. So basically a glorified promissory note. Yay! When an RHer buys GameStop, a whole bunch of things happen behind the scenes, all of which are the ugly plumbing of Wall Street. And here it kind of highlights that via tweet. It says, I'm simplifying, but because the buyer does not know who the seller is, the brokers for both buyer and seller use a third company called the DTCC to actually match and clear stock transactions, moving title from selling broker to buying broker while ensuring proceeds are moved on time. And so the DTC, that is the clearinghouse, and we're going to get into that, and I've got more color surrounding that as well. So side note for later. For equity option contracts, puts, and calls, the primary clearing entity is OCC, the Options Clearing Corp. I'm going to refer to DTCC below, but know that the same story can be told for options with OTC. Clearing for U.S. equities is generally a T+2 process settlement. Takes no more than 2 days from the trade, but the buyers' and sellers' brokerage accounts generally reflect the transaction immediately. Behind the scenes, there is lending. Lending means counterparty credit risk. The DTCC provides its balance sheet to guarantee settlement. But its balance sheet isn't that big, so it has to tightly manage counterparty risk to guarantee accurate settlement. And this way, DTCC is both a central repository for title and also the guarantor of title. This guarantee is typically an extremely low-risk proposition. However, low risk does not equal no risk. So it continues on, says generally DTCC holds the physical title to your stock. This speeds up settlement. DTCC simply assigns title from one DTCC client to another to clear the transaction. The DTCC clients are the brokers, and so the title is held in street name, the broker's name, not your name. Continuing on, so you bought GameSpot. It says in your RH margin account, what's happens behind the scenes. 1, you buy. 2, at day's end, RH nets all the money it needs to send to DTCC. 3, if RH is a net sender, it generally borrows that money cheaply via interbank lending and sends it to DTCC. 4, DTCC sends net proceeds to brokers due to receive. And 5, formal settlement happens within 2 days. So if you look at that, there are different windows of credit risk. 1, from Robinhood to DTCC between transactions time. Example, you buy at 9:45 a.m. and close a business when net proceeds go to the DTCC. 2, from the DTCC versus DTCC between the time they settle net proceeds and formally settle the transaction. Then you have from number 3, selling broker versus a selling client. The selling broker fronts its client credit for the proceeds immediately upon transaction. 4, DTCC versus selling broker. The DTCC owes the selling broker proceeds at day's end. And then you have Robinhood versus Robinhood client. You deposit $10,000 in your Robinhood account to open it. It's a margin account. You start buying stocks for 0 commission. You're not paying anything. So Robinhood doesn't make any money on that. Or do they? It's actually not particularly important to the story, but we all know Robinhood's real customer is not you. You are the product. Robinhood's real customers are buyers of order flow, the largest of whom is Citadel. The same Citadel that bailed out Melvin Capital with 0.72 on Monday. And just because you aren't Robinhood's real customer doesn't mean they don't care about you. They need you to be happy and active in order to continuously sell you to Citadel. A Citadel ATAL get a sneak peek at Robinhood's order flow, in effect the pending trade activity, and use that to provide you liquidity, in effect the front run your trade. Citadel makes tiny amounts on each transaction, on average, slightly reducing the quality of your execution, on average, but allowing you to pay no explicit commission. So now you own GME stock in the margin account. Actually, you don't. Robinhood owns the stock and simply passes through many of the rights of ownership to you, crediting you with quasi-ownership. This is important because if Robinhood failed, you would not own your stocks per se. You would be a creditor with a claim against Robinhood. This is a key risk of margin accounts, and that's probably an important point to make there. And of course, they highlight Lehman Brothers, which, by the way, failed back in 2008. When you signed your customer agreement and terms of service, you gave Robinhood the ability to take the stock you bought and lend it out to others to short. Depending on how hard to borrow that stock is, Robinhood gets paid a variable rate for this stock loan. While many brokers share the proceeds of stock lending with clients, Robinhood does not. Robinhood keeps it all. This is a critical way Robinhood gets paid. This payment can be very large on hard-to-borrow names. And of course, if you remember right here, the back half of the week, that is exactly what they did. They basically blocked people from being able to buy large amounts of the stock, and I think they limited down on GME down to 1 or 2 shares, if I recall, and then they did that across about another 35 others as well. Lending, Microsoft, which is easy to borrow, pays very little. Lending GME, which is very hard to borrow, may pay 50 to 100% or more per year. The borrow rate is set by the market and is frustratingly opaque. The rate gets reset daily as the difficulty of borrow fluctuates. So shorting in practice. Somebody wants to short GME. Most high-frequency traders that short sell first ping their PB to locate borrow. In order to meet legal requirements, the broker has to find unlent shares, so the same shares aren't lent twice. The PB will tag those shares, indicate to the client the prevailing cost to borrow, and provide the client a locate ID that guarantees that client those shares. Information in hand, the HF manager decides whether to go forward. If she wants to short, she instructs her trader to sell, and provides the trader the locate ID, tagged to the shares that were shorted, to match with the transaction so that everything works on the back end. So let's look at the HF's transaction. The PB lent the HF specific GME shares, which the HF immediately sold, receiving cash. The HF balance sheet owes shares and has cash. The HF receives money market interest on the cash in its account, called short rebate. This is nominal in today's ZIRP, zero interest rate world, but it can be meaningful in a high interest rate environment. The HF pays borrow costs on the owed shares. It says, as you know, because the HF owes shares and not money, its performance moves precisely inverse to the share price movement. Profit on decline, lose on increase. So behind the scenes, the PB deals with plumbing. The PB needs to find someone who owned the GME shares with clean title. Ideally, the PB found those in-house from another client of the same brokerage, but often they locate them from a third party like Robinhood or another brokerage house. The PB pays RH daily for the borrow and charges its HF client daily. Now, zoom out. RH's margin client, a retail investor, thinks he owns shares. He never did because it's a margin account. RH itself actually owned the shares in street name. RH lent those shares to a high-frequency broker, aka hypothecation, in exchange for daily borrow fees. That loan creates a debit/credit relationship between Robinhood and the broker. The PB took those borrowed shares and relent them to its client, who sold them to a fourth party. The RH client and the fourth party simultaneously own the same shares. So a summary from various perspectives. The RH client is a stock credited to its margin account. This is actually a promise from Robinhood. The HF owes GME stock plus borrow interest, and it owns cash from the short sale, which is credited to its margin account. It receives interest on that cash, even that cash is actually just a promise from its PB. RH has a security loan to PB and collects the variable borrow interest in the meantime. PB owes Robinhood stock and daily borrow interest. PB holds HF client margin account assets as collateral. HF pays PB a daily borrow rate. PB scrapes a VIG off the borrow rate and pays the balance to Robinhood. A fourth party owns the actual shares that the RH client thinks they own, and DTCC is recording the ownership chain and ensuring cash from purchase and to sale flows through. So, did you capture all that? Is that enough to make your head spin? So yeah, as we punch in digits on a screen and think that we own something, in reality, this is what is actually happening behind the scenes. DTCC's main worry is that someone mid-chain hits a problem. And if that happens, the problems flow all the way up to the chain to RH's client and down the chain to DTCC. In this way, RH is at risk to downstream problems. So the plumbing metaphor is apt. When you flush, a downstream clog causes a mess that backs up into your toilet. Don't handle that clog well and you end up with a mess on your floor. Handle it really poorly and you burst a pipe. Wastewater seeps into your walls. So to avoid this, DTCC has risk weightings based on the counterparty and the securities. When GME became the most volatile asset in the world, it created massive risks to the system. Likewise, DTCC views transactions from margin accounts as riskier than from cash accounts. From the broker's perspective, its risk with regard to margin accounts is mitigated by the broker's ability to close clients out of positions, liquidating them when risk thresholds are breached. Stocks that are extremely volatile increase the odds of breaches. So to mitigate the risk of a failure to get paid, DTCC requires brokers like Robinhood and other brokers to keep collateral on deposit at DTCC, cash and treasuries, in proportion to the risk that broker poses. And of course, I'll pause right there and we'll say that just the other day, if you remember right, that Robinhood had to come up with a little bit of cash behind the scenes, and it was for that reason. As more and more of a broker's DTCC assets increase in risk, for example, the GME becomes disproportionately part of Robinhood's assets, DTCC says to Robinhood, you need to send us more collateral. There you go. That's exactly what happened. Collateral means liquidity. Liquidity is the oxygen of financial markets. Accessing liquidity is easy when you don't need it and hard when you need it. So maintaining big buffers is important. So far, I have skipped a major, perhaps the major part of the GME story. Options. So if you've seen my tweets from the past few days, I said the GME situation is no longer retail versus hedge fund. It is hedge fund versus hedge fund. The dollars at play are unbelievably massive in relation to the companies we are talking about. Everyone, both the longs and the shorts, knows that GME, AMC, ATAL are all shorts in the long run. In the meantime, they're trading footballs. The players are all punters and hunters. The punters are gambling. Many gamblers are skilled, but most are patsies. The median punter loses money. The hunters are trying to figure out how to capitalize on the inevitable long-run outcome. Since I know GameStop will be lower in the long run, how do I profit from that? They lend to be choosy. In the case of a short squeeze, the long run is just the other side of the squeeze. It could be days. It's not likely to be many months. If you look at historical analogs, the collapses are as breathtaking as the squeeze. This is where options come into play. Buying options is a way of borrowing money, but capping your risk of loss. You cannot lose more than you put in, but you receive nearly uncapped upside. In exchange for capping your max loss and getting exposure to huge upside, options have fairly high odds of expiring worthless. So if buying options provides nearly uncapped upside, then, tautologically, selling options has nearly uncapped downside. Sellers collect premium up front, and most of the time you keep it. But when you lose, it can be bad. Selling options resembles an insurance contract from the insurer's perspective. Receive small upfront payments and occasionally pay out big in disasters. Selling options is a classic picking up pennies in front of a bulldozer. Some people joke that when you buy options, you join a group of people throwing pennies toward a guy in front of a bulldozer. If the bulldozer runs over the guy while he's picking up your penny, you get to keep all the pennies in his pocket. Nice analogy there, I guess. Continuing on, as the GME short squeeze took flight, anyone who had sold calls was in deep shit. Their toilet was flooding and flooding and flooding. If in December, when GME was at $15, I sold $20 strike calls on GME with a February expiration for $1.75, I'd have received $175 per contract. Each contract represents 100 shares. Above $21.75, I start losing money. With GME at $300 a share, that contract now sells for $280, or about 28 grand. I'd have lost $27,825 per contract. And there you see the math. That means I lost around 280 times the premium I received. No bueno. Even a tiny position could bankrupt you. I'm not going to go into this, but many market participants finance their option purchases, in effect borrow on margin to buy the option. Your head might explode if you think about that too long. And so I think I'll just leave that there. There is a little bit more to this. It's enough to make your head swim, frankly, but it is a very good explanation of what is going on. And the key thing I think that's important out of this is the whole DTCC. Why is that? Well, the Depository Trust and Clearing Corporation, if you head over to old Wikipedia, it's the clearing corporation, right? It's an American post-trade financial services company providing clearing and settlement services to the financial markets. It performs the exchange of securities on behalf of buyers and sellers and functions as a central securities depository by providing central custody of securities. They were established in 1999 as a holding company to combine the Depository Trust Company and the National Securities Clearing Corporation, NSCC. User-owned and directed, it automates, centralizes, standardizes, and streamlines processes in the capital markets. Through its subsidiaries, DTCC provides clearance, settlement, and information services for equities, corporate and municipal bonds, unit investment trusts, government and mortgage-backed securities, money market instruments, and over-the-counter derivatives. It also manages transactions between mutual funds and insurance carriers and their respective investors. Another interesting highlight, take a look at where they're located. 55 Water Street. 55, 5 by 5 Water Street, New York, New York. Watch the water. Interesting. I think we might have heard that a time or two before. Nonetheless, carrying forward, there is another interesting piece I want to highlight in the Wikipedia here, and it is this, getting down to, let's see, where did we go? The naked short selling. Here we go. So several companies sued the DTCC without success over delivery failures in their stocks, alleging culpability for naked short selling. Furthermore, the question of whether DTCC is culpable for naked short selling was raised by Senator Robert Bennett and the North American Securities Administrators Association, NASAA, and discussed in articles in the Wall Street Journal and Euromoney. DTCC contended that the suits were orchestrated by a small group of lawyers and executives to make money and draw attention from their company's problems. Critics blame DTCC, noting that it is the organization in charge of the system where the naked short selling happens, alleging that DTCC turned a blind eye to the problem and complaining that the Securities and Exchange Commission had not taken sufficient action against naked shorting. So, very, very interesting. That happened July 2007. Senator Bob Bennett, Republican of Utah, suggested on the U.S. Senate floor that the allegations involving DTCC and naked short selling were serious enough to warrant a hearing. So, obviously, if you look at this on the underbelly, you know that a lot of questions have come up, a lot of hearings have come up, suits and whatnot. And kind of to continue on that theme of the old DTCC, going back through my archives here back to about 2012, John Keating explains the DTCC, notes, certificates, bonds, etc. This was updated again in 2019. I'll jump forward to about here. It says the company switched day-to-day command of its operations to its office in Tampa, Florida, and moved control of the technology that runs its clearing and settlement business and record-keeping to its Dallas data center the weekend before the Atlantic's largest ever tropical storm, which was at the time, I believe, Hurricane Sandy. Yeah, there we go. That being said, Michael Bodson, President and Chief Executive Officer of the New York-based DTCC, said in a telephone interview, the average value of transactions processed weekly this year is $23.1 trillion, DTCC said. So I don't know if this number is actually updated to 2019 numbers or if this is still 2012, but that is an enormous number, 23.1 T with a trillion, back perhaps as far as 2012, and that is on a per-week basis. The DTCC handles trades in U.S. equities and government, municipal, and corporate bonds, and is more important to how markets function than the New York Stock Exchange or Citigroup, according to James Angel, a professor at Georgetown University, McDonough School of Business in Washington. It says, of the approximately $35 trillion in securities for which DTCC provides services, the vast majority, a percentage in the high 90s, is in electronic form only. So, again, think of this. At the end of the day, it isn't just pieces of paper that are being traded back and forth. They're trying to put a lot of this stuff in digital form. And think of what I just described by way of the plumbing in that, right? If the plumbing gets clogged, then of course you got all these risks and things bouncing around trying to trade certificates and whatnot behind the scenes. You can imagine the mess and that creates. So, in any case, Wall Street bets. Yes, that's exactly where we are at this point. So continuing on that theme, we get to this from the Gold, Goats, and Guns blog from Tom Luongo, Market Weekly. GameStop Revolution or the Matrix Reloaded? Where is this headed at the end of the day? Says, I have to say, as revolutions go, this one is hilarious. GameStop opened this morning above $330 a share, a sentence I never thought in a million years I'd ever write. Keep in mind, folks, I believe the normal price should be somewhere down around in about the $13 to $15 range. So that being said, it says this open nearly ensures that all attempts yesterday to push the price back down to bail out the hedge funds desperately short have failed spectacularly. There's options expirations today which will fundamentally change the way we look at markets. If GameStop closes in this range, because it shows that when people act in the aggregate, they can overwhelm the attempts by a few central planners to control you. And I think that's the little kink in the cog, as it were, as to why this is unwinding the way it is. Because if you think about how the markets work today, everything is algorithm traded, right? All these brokerage houses, the big banks does, the hedge funders and whatnot, get all these data scientists, these really smart mathematicians, and they build all these algorithms out, and what do they trade on? Headlines, keywords, positive versus negative, which way to trade, and these things happen in split seconds to make decisions. It's the first one to the trough, basically, who gets the money and who does not. And so they rely on very fast technology, really handy-dandy algos and that to do the trick. And gee, where do you think things could possibly go wrong? Think back to what happened with our election and algos, right? If you blow up an algo, what happens? Uh-oh. Suddenly things freeze up, you gotta do an about face and stop, and then figure out what the hell to do. So this is kind of the same deal. It says your best proof that this is at least a part of what's going on is the way Wall Street and the regulators in D.C. are reacting. Because they are screaming that this is outrageous, that we need stronger enforcement tools to ensure the integrity of our markets. That's just code for only we're allowed to game the markets, not the little people. And with options expiring on GameStop nearly every week in February and March, this game isn't over by any stretch of the imagination. So populist is a four-letter word. In fact, it's the beginning of a new form of populist revolt. We've seen what they think of populist revolts. They have utter disdain for them. They quash them and hope to ignore the consequences. Vote for Trump? Can't have that happen again. Speak out against any facet of the Great Reset? Get censored. Try to build a new platform not controlled by them? Get deplatformed. Show up at the Capitol to peaceably assemble? Get caught up in a false flag to justify arresting you and shaming you into submission? Today's price action in GameStop and other stocks heavily shorted by hedge funds is simply the next iteration of the people finding ways to make their voices heard. If you remove someone's ability to speak in one area, they will find a way in another. And Don't for a second think the irony of this evolution of Occupy Wall Street occurring during the World Economic Forum's virtual Davos is lost on me. It isn't. In an age where we are forced to wear masks in ritual submission to oligarchic control, they hide behind ever bigger barriers to our hatred of them. As we saw on Capitol Hill 3 weeks ago, public assembly in the age of COVID is a recipe for even more wound collecting by the oligarchy, who have their media quislings turn it into bad PR for how unruly the little people are to scare the normies. So, Black Skull's event horizon. But what happens when the little people don't care about making money or any of those other rational investor/actor assumptions, which undergird the value at risk equations used by most hedge funds and Wall Street quants? What happens when someone finally blows the lid off the assumption that the risk-free rate of return R squared or R asterisk, I guess, in the Black Skull's equation is anything less than 1,000% for a $100 call option on GameStop? Well, today it means a few rich people will be made poor and a lot of poor people richer. The bigger question, however, about all of this is what happens when, finally, the markets admit that the R asterisk for U.S. Treasuries is not zero. Because that's what this whole GameStop revolution is really about. Opening up major cracks in the confidence and validity of the institutions that are supposed to be so unassailably powerful that markets rely on to justify insane valuation models. They made a mistake staging their failed Tiananmen Square moment at the Capitol. No one other than them was really upset about it, other than people getting shot. Her name was Ashley Babbitt. It means that for a moment, and possibly a few more moments, given how screwed up our financial system is, the little guy's anger just got capitalized. They hate us for our freedoms. And the irony is, the seed capital for this came from their own disdain for us. When the last round of stimulus checks showed up, I don't know about you, but I was angry. My wife and I stared at it for a few days, and doing so made us viscerally mad. And I guess I'll digress there and think of old Clark Griswold when he got the old check in Christmas Vacation, thinking he got a bonus, and it was the Jelly of the Month Club. That's about what it equates to with the scraps that Pelosi allowed the little people to have by way of the $600, right? Says it represented just how little they thought of all the people whose lives they've ruined, paying out the bare minimum to hold us over until they'd fully consolidated power behind barricades and 25,000 troops in D.C. When asked about what I would do with my stimmy check, I replied the same way every time: pay my taxes with it. But even if 2020 was good for you, financially as it was, admittedly for me, all of this COVID destruction destroyed something far more important: quality of life. It wasn't about the money. It was about what was truly lost. The personal bonds broken. The psychological damage to my daughter trying to school via Zoom while going slowly insane. The destruction of my weekly Guys Night Out board gaming group, and now my martial arts school, a staple in our lives for over 25 years. We shared one last pitcher of beer last night, holding back tears. The haunted looks of my friends and favorite local vendors trying to keep it together. We all have those stories. They take their toll. The scar tissue builds. So, when that check showed up, after 6 months of Nancy Pelosi, or should I say Nancy Antoinette, burning down people's lives even more to burn down her nemesis Donald Trump, we all knew what the score was. They care about you like a virus cares about its host. And finally, after a year of this, instead of sitting around wondering what DLC to buy for Fortnite with their stimulus check, a bunch of really angry smart guys said, "You know what? F these assholes." And so, hours after we tweeted this in June, we got the following letter from Citadel's lawyers, and yes, Zero Hedge called them out back then as well. It says, and they got a whole lot of people with nothing left to lose except their payola to not disturb Queen Nancy to go along with them. So is this a revenge of the nerds? Well, that anger, as I said, is now pretty well capitalized, the same way that 2017's cryptocurrency rally capitalized a whole lot of committed anarcho-assholes of all political stripes to build on top of Bitcoin's reserve status. The early fruits of that labor are also on display today. Not because these guys are pushing their GameStop profits into Dogecoin, but because after a massive coordinated attack to break Bitcoin after the peak was $42,000 2 weeks ago, it couldn't be beaten back below $20,000, the previous all-time high. All of a sudden, there were places to park crypto profits which weren't US dollars. The assets were all off-ramps, could be shut off, and the little people trapped inside Coinbase getting slaughtered while it's down for maintenance. That's why today is so fascinating. Wall Street thought all they had to do was double down on their GameStop shorts and use their hammer to beat the nails back into the board. It didn't work. By then, this thing had gone global. Now, you have to wonder who is helping the rabble push GameStop back above the $210 Maginot line. Once something like this starts, Wall Street's enemies start coming out of the woodwork to piggyback on the chaos and change the board's state of global markets. Think China, Russia, and everyone else sanctioned to hell and gone by neocons in our government in the service of Israel. And today's close will force a lot of people to scramble and find the money they need to cover their losses, or these meme lords will own enough shares to not only own GameStop's board, but also have money left over to go after someone else. Maybe American Airlines, maybe BlackBerry, maybe Nokia. This is the first real battle in an asymmetric warfare, and those stocks would be very interesting to see successful populist raids on. Can we say hostile takeover and a recapitalization of BlackBerry or Nokia outside of the Apple/Google mobile web duopoly? I'd sell my iPhone if that happened. Hey, I'm just vamping here, but if these guys are serious about doing damage and re-leveling the playing field, that financial advice I'm not allowed to give you, but you can have it for free. Reality is that which when you stop. At the same time, there's also the reality that when the masses storm the financial Bastille like this, there's a lot of bystanders run over in the process. The guys at our Wall Street bets understood the structure of the markets. They understand that Robinhood had to shut down trading on GameStop, and others simply because Robinhood wouldn't have enough cash to post required collateral thanks to Dodd-Frank. And Diogenes had this to say, postscript, this thread is the best explainer on the regulatory capital issues I referenced. Silent kill, and I think that pretty well ties into what we just covered by way of the plumbing. Moreover, it's going to cause real problems with clearinghouses and primary banks. Robinhood had to tap more than $1 billion to cover the collateral. And today's close will make that number bigger, which makes me wonder if this chaos unleashed by the GameStop revolution doesn't have a more sinister angle. One where an upstart retail brokerage was stealing too much market share for trading fees and, like the trolls on Reddit, was making too much money threatening the someone else's business. So believing in it doesn't go away. So, is this an elaborate hit job inside of the populist uprising like what we saw at the Capitol Hill on January 6th? Like I said, at the outset, the usual suspects are all out there today saying we need wealth taxes and trading fees on stock trades. There will be punishment for upsetting the sanctity of our capital markets. Are we all just, as always, having our chains jerked by a bunch of psychopaths looking to advance a new regulatory environment where the validity of capital markets themselves are undermined? Because you don't think the commies who just performed a coup in D.C. through blatant election fraud and whose masters are bloviating about rebooting capitalism as I type, this would concoct such a thing, would you? Surely, things couldn't be that corrupt. No, power to the short squeeze, and all hail Elon Musk. If you don't think that's possible, then I've got some GameStop January 2023 leaps at $250 strike price to sell you. As many as you like, 140% of the float even. I sincerely hope I'm wrong, but something tells me I'm not being cynical enough. So, I thought that was a pretty interesting take on it. Hopefully you find that interesting as well. Something to consider, certainly. And continuing on that thread, we get into this. So, you just rated your first company, a letter to non-professional traders. And this was penned by an anonymous person sent over to Zero Hedge today. Says, so, you just rated your first company, a letter to non-professional traders. Congratulations to Wall Street Bets. Gamma trading is fun, and anyone who has traded the market for the past 3 decades saw this coming. As capital markets look toward Monday and what is priced in to GameStop, something bad is happening. And if nobody says something, the consequences will harm everyone. For background, I'm a portfolio manager who has been doing this since before 2009. This will be my 3rd market cycle. Zero Hedge has written extensively on market manipulation, specifically in commodity markets and equities using boiler rooms and high-frequency trading algos such as the infamous ignition trades. Much of this knowledge has not been properly communicated or shared with Wall Street Bets, retail traders. A short squeeze is legal, but when a coordinated attempt at price manipulation is attempted, then it can be defined as a dangerous offense. This is a gray area. If you are new to finance, please study up on what happened when previous traders have tried to corner the silver market, or the infamous Volkswagen trade or LIBOR manipulation. Unwinding and the liquidity drains on the larger capital market to solve these trades are dangerous. On a related topic, liquidity trades can have unintended consequences on other parts of the economy, such as when program trades in 1987 led to a flash crash. The capital markets work on a public hazard principle, much like driving a car. You drive safe to protect the other guy. You can drive fast, but the damage caused to the reputation of the market and confidence in counterparty risk can be permanently damaged, just like a deadly car crash. And the margin of error, like extreme speeding, can wipe you out in a second. A flash crash can wipe you out. Be hedged and make sure you understand the math and market structure of these leveraged trades. Retail investors must understand or should be made aware of that gamma trading depends on liquidity shortages. And as we saw in the market action of GameStop and other stocks today, this market structure is dangerous to everyone. Complacency on 50% moves upwards must also be monitored, and expected losses of 50% or more must also be factored in before people invest. In much the same way people must make educated investments before making investments in options, where unlimited losses may happen or stocks on margin. The reason I say this to you is because every mania since 1918 has led to a major market crash over the past 100 years. In every major market crash, it was retail accounts being locked out, and which led to crippling economic losses amid the retail public, who exuberantly placed their savings into the market. Many people today complain about their retail accounts to Robinhood and Ameritrade being locked out for various unconfirmed reasons. However, if one were to Google, this is a very loud alarm bell of a market top. In 1929, Joe Kennedy was horrified and wrote to the Wall Street Journal that manias were encouraging retail traders to form trading clubs and were investing in insole trusts. And hundreds of penny trade brokerages were emerging in New York to prey on their inexperience. The insole trusts were over-leveraged assets, often real estate and utility companies, which were propped up by stock buybacks and equity speculation. When the first market crash happened, which led to the Great Depression, it was the penny brokers, unable to satisfy retail accounts due to the brokerage's own cash crunches, which led to the infamous riots and wave of iconic jumping suicides in the weeks after the crash. Those were not bankers who killed themselves, but wiped out retail punters, as documented in many economic history books about the crash. In 1998, again, after a euphoric mania, the dot-com bubble stocks gave way to the collapse of the tech sector. Following the disaster of the Pets.com IPO, in the flash crash, retail investor accounts were locked, preventing millions of Freedom 55 investors, Generation X and Boomers, from trading out of their positions. Many of those households and their savings were wiped out. Those households which survived 1998's market crash and recession only returned to their previous wealth level after inflation adjustment in the early 2010s. Faith in retail brokerages, market integrity, and public trust in banks never recovered. Even to this day, Legislation like Glass-Steagall is spoken about, but nobody really remembers why or how it happened, or its consequences to those who suffered the most in 1998. Like 1998, we have seen Robinhood and other retail traders allegedly start to moderate access to the stock market. Economists talk about an economic event called a Minsky moment. Given the market signals, retail investors should review these economic signals before a Minsky moment happens in this momentum-driven market. I would not be shocked if Robinhood is the new Lehman Brothers and we are months away from a major crackdown on capital markets by regulators. I also suspect that should GME suffer a Minsky moment, the thin liquidity structures in our current market will trigger a major market move similar to 1987. I will say I have not studied this specific issue to cause alarm, but if regulators are not watching this issue and its parallels to history, now they should be. In other words, so be safe out there. So, perhaps a bit of caution. Again, I'm not offering investment advice here by any means, just highlighting what is going on here over the course of the last week. Obviously, if you are compelled to do so, make sure that you do your own research. And by the way, just for the record, I stand to gain absolutely anything out of this as I am not a player in the old casino known as the stock market. Alright, so that being said, this is the stunning way some desperate funds covered their GameStop shorts. Still out of Zero Hedge. Says on Friday, we reported that while every hedge fund bro and tick-tocking millennial has been glued to the melt-up in heavily shorted stocks like GME, and the meltdowns in the hedge funds who were heavily short, there has been significant impacts under the covers of the rest of the financial markets that few have, for now, noticed. One place where the unintended consequence of the short squeeze hit hard was FANG stocks. It stands for Facebook, Apple, Netflix, Google. And the most popular and liquid names held by hedgies, the Goldman Hedge Fund VIP basket, which have seen liquidations to meet margin calls, as well as due to VAR shock-induced gross leverage drawdowns. In other words, the highest the most shorted names rose, the more selling in the most popular longs, as shown below. So here they show Goldman Sachs hedge fund VIP basket, which as the shorts started to take place, they had to sell their long positions in all these other stocks. And that's just one bank that they're highlighting, that Goldman Sachs. But it's not just pair trades that have gotten hammered. And incidentally, according to several desks, GME was the most popular short pair trade offset to the ubiquitous Amazon long, which is why we asked earlier if the WSB Army isn't coming after Jeff Bezos next. So Zero Hedge tweeted this out earlier. Says GME is the most frequent participant in Amazon pair trades. Goldman Prime. Is the WSB train about to come for Bezos? Interesting. Says as we noted on Friday, the outsized influence from the booming video game retailer has altered some ETF compositions and is forcing what city analysts call ad hoc rebalances and strategy adjustments. And one of the most stunning developments, roughly $700 million in assets was pulled from the SPDR S&P Retail ETF XRT this week. And here we see that. With a record $506 million pulled on Wednesday alone, draining the total assets to just $164 million. The outflows came after GameStop surge swelled its weighting in XRT to an insane 20%, which is unprecedented given the fund tracks an equal-weighted index. The video game retailer's weighting should be closer to 1%, according to Bloomberg's James Seifert. And there you see that. Says, while we don't know what specifically caused this record plunge in XRT assets, we speculated that one possibility is that because XRT redemptions are delivered in kind, meaning that its shares are exchanged for the underlying stocks in the fund, investors are ditching the ETF to get their hands on hard-to-borrow GameStop shares. As it turns out, that's precisely what happened. As Bloomberg, Seifert, and Balkunas explain, the $506 million outflow on January 27th cut XRT's assets to less than $240 million and offered further evidence of the stability of the ETF structure. Despite the plunge in assets, XRT's price was unaffected, closing at a $6 basis point discount. The January 27th outflow amounted to a 5.55 million XRT shares, lowering the total to 2.6 million. Yes, a huge move that barely impacted the price. That's good. It means that the market is still liquid enough for historic asset reallocations in ETFs. But that's not the punchline. And the punchline? The in-kind redemption was likely an attempt by investors to get their hands on scarce GameStop shares. Based on XRT's weightings, those who took delivery of the underlying holdings received about 292,000 GameStop shares, alongside 94 other stocks. Unprecedented? Well, yes, because as Bloomberg itself concludes, by allowing investors to redeem GameStop and other shares from its own holdings, XRT effectively acted as a dealer, akin to the role we see many liquid fixed income ETFs playing in the bond market. So why is this important? Because, as a look at GME borrow rates, courtesy of S3 Blacklight, shows, January 27th is precisely the day when the carry cost to hold GME shorts peaked, and at some dealers it soared as high as a suicidal 200%, according to S3 Partners. And there we see that on the 27th per that graph. This is Indy Thursday overnight session. The price of GME also peaked and has been drifting lower since. Here's the bottom line. One or more funds, perhaps facing a terminal margin call, was so desperate to close out their GME short in a market where the cost to borrow the stock had exploded as high as 200%, a death sentence for any hedge fund who plans to keep the GME short on for a long period of time, that they stripped XRT, which, as Bloomberg notes, acted as a dealer, of 292,000 shares of GSE to quickly plug the shortfall, no pun intended, and to emerge alive. As a result of this furious scramble, not only did the cost to borrow GME slide, but so did the stock price. So what does this mean? Is the panic squeeze over now that the cost to borrow GME has dropped? Well, maybe not, and here's why. With XRT effectively rated out of a paltry 300,000 shares, there are no more hiding places for GME stock to be rated. In other words, any shorts left are on their own. Meanwhile, as S3 Partners, Ihor Dzyznyski wrote on Friday, some 113.3% of the GME float is still short, synthetically, including rehypothecated shorts. What's worse, while the cost to borrow GME stock has dropped, it still remains around 30%, which means that no hedge fund can remain short the stock indefinitely without suffering massive losses, and yet still more than all of the float is short. Whether this means a GME squeeze will resume tomorrow, or whether with the help of Robinhood's effective shutdown and Citadel's friends in high places, the short raid will finally end on Monday. We leave it up to leaders to decide. So, in other words, tomorrow is going to be a very interesting day to watch to see how this plays out. Will they continue to pile into GameStop at this point? Maybe. They're going to force the hand of the hedgies, probably bankrupt them, perhaps. No more places to raid from, obviously, in order to cover their shorts. Perhaps maybe they've already moved on to others and are piling in there. Who knows? All right, moving along. So, silver. The question now is, all right, now that they've done what they needed to do with GameStop, perhaps they're piling into some other short positions as well. Bed Bath & Beyond, I think, are some. AMC, theaters, etc. There's a number of them. Silver is definitely one that is being questioned here. Silver futures soar 8%, rise above $29 as Reddit hordes pile in. This updated about 6 p.m. this evening. Says it was the one print everyone was waiting for, and here it is. Silver futures opened up 7%, surging from $27 an ounce to a high of $29.095, following a weekend of speculation that the next big squeeze on WSB's radar is silver. And whether that's true or not may no longer matter in a world where, as described below, there is virtually no physical silver to be purchased. And in my mind, That's a good move because there is so much paper trade out there, these ETFs and everything else that drive the price of silver, gold, and precious metals alike. It's time to eliminate them, get it back down to actual physical instead of the pretend paper claims, and which is absurd, absolutely absurd, and greater than about a 10-to-1 ratio. So it highlights that spot silver is back to its highest since the August/September cycle highs. Right now it was sitting about 28.5795, which goes all the way back to August of last year. Still got room to run. And if you think about this too, I think the ratio between gold and silver at this point is somewhere, what is it? It's still running about 73 to 1, I think it is. It's been as high as about 120 to 1 here within the last several months. Way higher than the norm. Gold futures managed very modest gains as well. You see that they're picking up. And silver's dramatic outperformance has pushed the gold-silver ratio to its lowest since 2014, which it is showing right now. Here we go, 65.04. So 65 ounces of silver to 1 ounce of gold. Silver miners are also getting the love. Australian silver stock, including Argent Minerals and Boab Metals, rise more than 20%. U.S. equity futures are taking a hit, all down around 1%. So, as silver approaches $30, keep an eye on major price slams emerging either out of central banks, who desperately need to keep precious metals lower, or the BIS itself, the Bank of International Settlements, whose Benoit Gilson will have a busy day tomorrow. And he's one of the head guys that does the fixing, if you will, over at the BIS. So I'll break from that there, and this is where it's going to get really fun. Why is silver important? Well, let's just play this through here for a second.
It's your lucky day today. You win a free 10-ounce silver bar, pure silver bullion, or a free Hershey's king-size chocolate bar.
Take this one.
You'll take the chocolate bar. Who needs a 10-ounce bar of silver? Have a good day. It's your choice. A free 10-ounce bar of silver bullion or a free king-size Hershey bar.
I think I'll take the Hershey bar.
Go ahead. It's your lucky day. Just
right.
Fresh out of the refrigerator.
Thank you.
Thank you very much. Who needs a 10-ounce bar of silver when you can have a good, delicious bar of chocolate, right?
Yeah, exactly.
Okay. All right, thank you.
Thank you.
You'd rather have the Hershey bar than the silver bar?
Yes, I would.
Oh, you would?
Yeah,
Okay.
the Hershey bar, you can eat the silver bar.
Yeah, that's right. You can't eat the silver. What are you going to do with a 10-ounce bar of silver, right? You know. Which one do you want?
Probably the chocolate, because I'm a girl and
Go.
it's been a cranky day.
Okay, it's yours. Eat it quick because it's getting hot out here.
Fine.
Just offering people a free Hershey bar today or a free silver bar. Which one would you prefer?
Silver. I'll take the.
Who needs a silver bar? Lucky day today. A free chilled Hershey bar straight out of the fridge or this bar of silver. It's 10 ounces.
What are you guys doing?
Which one do you want?
Well, I don't have any way to do anything with the silver.
Okay, so you prefer the Hershey bar?
Yeah, but is it real?
Yes. Just straight out of the fridge.
Doesn't seem real.
The Hershey bar doesn't seem real. I mean, we could go into this coin shop. We could verify the silver bar is real.
No, that's all right.
It's real.
I always take chocolate.
Always take chocolate. Enjoy. You're a winner today. We're offering a free Hershey bar right out of the fridge.
Okay.
Or a free silver bar. It's 10 ounces. It's a little tarnished. Which one do you want?
I don't know.
Chocolate bar.
Go ahead.
All right.
It's yours. You're a winner.
Oh, thank you.
You're welcome. Have a good day. You're a winner. You win either a free 10-ounce bar of tarnished old silver bullion or this Hershey bar just out of the fridge.
What is it? What's gonna happen?
Which one do you want?
Candy.
Go ahead. It's yours. All right. We got another winner. The Hershey bar giveaway. Thank you.
Thanks for watching. Subscribe to my YouTube channel.
Always like that one. What does it highlight here at the end of the day? You know, people have become quite ignorant of what our true money is, right? what is constitutionally mandated per our House of Representatives for a coin and determining the value thereof, gold and silver specie. But yet, you look at the ignorance that has just taken place here, and you wonder, right? And of course, this video is probably at least a good 5-6 years old now, but still very relevant here yet today. So that being said, along the lines of silver, why is this going to be interesting to watch? Well, again, if they're going to try and regulate and go after the old retail guys, well, perhaps we need a little trip down memory lane. So, hitting back through the old archives here, a lot of these articles that were on Zero Hedge, have them in my archives. Stand aside, JP Morgan, a new player in the silver market has arrived. Stating back to May 3rd of 2016, says the days of JP Morgan controlling the silver market may be numbered, as a new player in the silver market has arrived. For the past several years, JP Morgan held the most silver on a public exchange in the world. While the LBMA may hold, or did hold, more silver, their stockpiles are not made public. Regardless, JP Morgan held the most silver at nearly 74 million ounces in its warehouse up until recently. Over the past 2 months, JP Morgan's silver inventories have fallen nearly 7 million ounces to 67.1 million ounces today. As I mentioned in my previous article, why are the Chinese stockpiling silver? Big move coming. JP Morgan increased their silver inventories from 4 million ounces in April 2011 to 69.4 million ounces April 19, 2016. However, the Shanghai Futures Exchange silver inventory surged from 7.5 million ounces in August 2015 to 54.7 million ounces on April 19, 2016. And so I bring all that up to highlight JP Morgan. Obviously, they're talking about the Chinese stockpiling these as well, carrying that forward a little bit more historical perspective here. Again, another Zero Hedge article from back in the day, back in December of 2016. JP Morgan, HSBC, Credit Agricole, Bank Cartel fined $521 million for Euribor rigging. So, yeah, do you think, honestly, that the big bankstas in that, at the end of the day, don't have a vested interest in keeping the actual price of silver and or gold down? Because that's exactly what this highlighted from back then. It says, with the global bank stocks soaring on expectations and hope that financial sector regulation will be broadly swept away under Trump, today Europe did its best to show that, at least for now. The banks are not in the clear when the European Commission has fined JP Morgan, Credit Agricole, and HSB a total of 485 million euros, about 521 million US dollars, for rigging the Euribor benchmark as European Union antitrust regulators wrapped up a 5-year investigation into the scandal. The three banks colluded on euro interest rate derivative pricing elements and exchanged sensitive information in breach of EU antitrust rules. The European Commission said on Wednesday in an emailed statement JP Morgan was fined 337.2 million euros, HSBC got a 33.6 million euro penalty, and Credit Agricole must pay 114.7 million euros. Margaret Vestager, the EU's competition policy chief, said banks have to respect EU competition rules just like any other company operating in the single market. So why is that important? Well, as history will tell us here as we crank through this, JP Morgan was back in court for rigging silver prices back in the day. This dates back to, I think, December. Was it December? Yeah, December of 2017. Or February of 2017, rather. Appeals court overturns dismissal in JP Morgan silver rigging case. Via Soren K. and Market Slant, the New York Second U.S. Circuit Court of Appeals ruled yesterday that District Court Judge Engelmeyer was in error when he dismissed the silver price rigging lawsuits against J.P. Morgan. The appellate court felt that Engelmeyer's dismissal reasons amounted to impermissible fact-finding and placed too high of a bar in concluding that plaintiffs had not adequately pled their case. Jumping down, the appeals court overturns the dismissal yesterday. The appellate court held that the plaintiffs did in fact submit evidence that did in fact reach a level warranting further investigation. Therefore, the case should not have been dismissed. And quoting the law, the three judges stated, a plaintiff needed only allege enough facts to raise a right to relief above the speculative level, and state a claim to relief that is plausible on its face. They stated that Judge Engelmeyer's requirements for such specifics were too high to reach. describing the proof bar being raised to a level of detail not required to withstand a motion to dismiss. In essence, what Judge Engelmeyer asked of the plaintiffs was impossible to ascertain in those proceedings. Specifically, fact-specific questions cannot be resolved on the pleadings. And can J.P. Morgan monopolize silver? Yes. And that was the what was going on back 2016-2017 time frame. That being said, silver prices to surge. J.P. Morgan has acquired a massive quantity of physical silver. This now dating up to January of 2018. Silver prices to surge. J.P. Morgan has acquired a massive quantity of physical silver. They continue to accumulate the biggest stockpile of physical silver in history. JPM now holds more than 133 million ounces, more than was held in the Hunt brothers. Butler silver hoard owned by JPM has increased from 0 ounces in 2011 to 120 million ounces today. Money managers showing more optimism toward silver through record buying. Near impossible to rule out an upside price surprise at any moment. That was per Mark O'Byrne back then. Carrying that forward still, back to November now of 2018, JP Morgan gold spoofer admits manipulating precious metal markets for years. There was a time when the merest mention of gold manipulation in reputable media was enough to have one branded a perpetual conspiracy theorist with a tinfoil farm out back. That was roughly coincident with a time when LIBOR, FX, mortgage, and bond market manipulation was also considered unthinkable, even when high-frequency traders were believed to provide liquidity, or when the stock market was said to not be manipulated by the Fed. And when the ever-confused media, always eager to take complicated financial concepts at the face value set by self-serving establishment, never dared to question anything. Of course, now that has changed. And what may be the first major bullion bank trader coming clean, a former JP Morgan precious metals trader admitted he engaged in a 6-year spoofing scheme that defrauded investors in gold, silver, platinum, and palladium future contracts. John Edmonds, 36, of Brooklyn, New York, pled guilty under seal on October 9th in the District of Connecticut to commodities fraud, conspiracy to commit wire fraud, commodities price manipulation, and spoofing. So, that being said, flashing forward yet again, we get to this. The DOJ accuses JP Morgan's precious metals trading desk of being a criminal enterprise. This a little bit later in 2018, we find who would have thought that JP Morgan's precious metals trading desk is the functional equivalent of the mafia, and that its one-time leader, Blythe Masters, was the mafia's don. Well, almost everyone who didn't mind being designated a conspiracy theorist for years, and now comes vindication, because this has just been confirmed by the DOJ, which accused the PM trading desks at JP Morgan of being deeply involved in what prosecutors described as a massive, multi-year scheme to manipulate the market for precious metals future contracts and defraud market participants. In an indictment unsealed on Monday morning, the DOJ charged Michael Novak, a J.P. Morgan veteran and former head of its precious metals trading desk, and Greg Smith, another trader on JPM's metal desk, in their probe. Blythe Masters was somehow omitted, based on the fact that it was conduct that was widespread on the desk. It was engaged in thousands of episodes over an 8-year period. That it is precisely the kind of conduct that the RICO statute is meant to punish, Assistant Attorney General Brian Benchkowski told reporters. And that was from back then. So, that being said, you think about how this is going to play out. Is it a David versus Goliath type situation? Maybe. Is it going to raise the ire of the folks on Capitol Hill? Perhaps. Obviously, it has caught the attention of both Dems and Republicans alike. It seems to bridge the gap, as it were. Doesn't matter which side of the aisle you're on, either side of the coin at the end of the day. But it's going to be interesting to see how this plays out, right? Because on the one hand, they're going to try and come back and say, all you little guys out there, you retailers, net using your little Ameritrades, E-Trades, and Robinhoods and whatnot, oh, we got to regulate you guys. But look at what we just saw happen. The big banksters typically get a slap on the old wrist, and off they go, but yet they operate as criminal enterprises. Let that sink in. And perhaps that may be why they may go after somebody like silver, because if they start going after all those paper contracts, guess who's going to have to ante up some dollars in order to cover those shorts? Perhaps maybe those 120, 130 million silver ounces sitting in the old vaults at JP Morgan may suddenly start having to be liquidated. In any case, a bit of a funny piece here. Brady Snow says, "Dear hedge fund managers, I know times are tough, and you just lost $70 billion. But here are some suggestions to pick yourself up. Night school. Cut your spending. Pick up a part-time job. Think of a change of trade. Learn to code. Work longer hours. If all else fails, remember, the government might give you a check for $1,400. Sometime. Soonish. Or not." So that, and it kind of lends itself to this as well.
Keep my head up, and you will end this.
I'm just getting warmed up. This is von Clausewitz shit. Total fucking war. I'm gonna pull the whole thing down. I'm gonna bring the whole fucking diseased, corrupt temple down on your head. It's gotta be biblical.
So perhaps, maybe that will indeed be the case. We don't know, but nonetheless, it'll be fun to watch. So we shall see. And of course, in case if you've missed any of the episodes, you can head over to the archives page here. Get subscribed over there as well. You can see past episodes, all that good stuff there as well. All right, well, that is going to do it for this episode of Midnight Rider. Appreciate you guys tuning in. It's going to be a fun week to watch. I'm going to have a lot more to report on that throughout the week. We'll see whether or not the little guy actually wins, or if this is going to indeed bring the whole stinking thing down. Stay tuned. I'll see you back here real soon. Take care. God bless everybody.